Have you ever felt a subtle unease, a nagging suspicion that something isn't quite right with your financial picture? Perhaps it's the returns that never quite match the promises, or the creeping feeling that your wealth isn't growing as rapidly as it should. We often focus on the big picture, the grand strategies of investing, but sometimes the most significant threats are the silent, unseen ones. These are the hidden fees lurking within your financial advisor's seemingly benevolent guidance. Think of it as a slow leak in a tire. You might not notice it at first, but over time, it steadily depletes the pressure, impacting your car's performance and fuel efficiency. Similarly, these hidden fees act as a constant drain on your investments, a death by 1,000 cuts that can decimate your wealth over the long term. The truth is, the financial advisory landscape is riddled with inherent conflicts of interest. Fee-based advisors, while often presented as the epitome of unbiased advice, can be subtly incentivized to prioritize their own compensation over your financial well-being. It's a delicate dance, and one that requires a discerning eye and a healthy dose of skepticism. Benjamin Graham, the father of value investing, wisely cautioned that obvious prospects for physical expansion do not translate into obvious profits for investors. This holds true in the financial advisory industry as well. The growth in assets under management, or AUM, doesn't necessarily equate to better outcomes for you, the client. In fact, it can sometimes mask the very fees that are eroding your returns. So, how do you protect yourself from these silent wealth thieves? How do you ensure that your financial advisor is truly acting in your best interest? Over the next few minutes, we are uncovering 5 specific hidden fees that are likely lurking in your financial statements. More importantly, we'll equip you with actionable strategies to mitigate their impact, empowering you to take control of your financial destiny and build the sustainable wealth you deserve. Are you ready to pull back the curtain and expose these hidden dangers? Let's begin with the first hidden fee, the AUM illusion. Assets under management fees, or AUM, are perhaps the most common and seemingly transparent fees in the financial advisory world. They're often presented as a straightforward percentage of your portfolio, but this apparent simplicity can be deceiving. The fundamental issue lies in how these fees disproportionately benefit the advisor as your portfolio grows, regardless of whether your performance keeps pace. Consider this: a 1% AUM fee on a $1 million portfolio translates to $10,000 per year for the advisor. Now, imagine that same advisor manages a $10 million portfolio. That 1% fee now generates $100,000 annually, a tenfold increase in income, even if the relative performance remains the same. This exponential growth in advisor income, independent of your actual returns, is the heart of the AUM illusion. It's tempting to assume that higher AUM automatically equates to superior service or investment expertise. However, this isn't always the case. In fact, many advisors engage in what's known as closet indexing, essentially collecting fees for passively tracking the market, offering little to no added value beyond what you could achieve with a low-cost index fund. The alternative: explore fee-only advisors who operate on a flat fee or hourly basis. This model aligns incentives more closely with client outcomes, as the advisor's compensation isn't directly tied to the size of your portfolio. Think of it like owning a rental property. Would you pay a property manager a percentage of the rent even when the property is vacant or requires constant repairs? The same principle applies to AUM fees. Scrutinize the value you're receiving for the fee you're paying, and don't be afraid to explore alternative compensation structures. Now, let's delve into the second hidden fee, transaction costs. Often overlooked, these costs operate as an invisible tax on your investments. They extend far beyond simple brokerage commissions, encompassing bid-ask spreads, the market impact of large trades, and even the opportunity costs associated with frequent trading. Actively managed funds, despite their promises of superior stock picking, often generate significantly higher transaction costs. The constant buying and selling, driven by the fund manager's attempts to time the market or capitalize on short-term opportunities, can erode your returns, particularly in volatile market conditions. Consider the data. The turnover ratios, which measure how frequently a fund replaces its holdings, are typically much higher for actively managed funds compared to low-cost index funds. This frequent trading translates directly into higher transaction costs, creating a long-term performance drag that's often hidden from view. The solution: embrace a buy-and-hold investment strategy and prioritize low-cost index funds or ETFs. By minimizing trading activity, you significantly reduce transaction costs and allow the power of compounding to work its magic. Moreover, focus on tax-efficient investing strategies to further minimize the impact of taxes on your returns. Think of transaction costs as a leaky faucet. Each individual drip may seem insignificant, but over time, these small drips can drain a significant amount of water. Similarly, seemingly minor transaction costs, when compounded over years, can silently erode a substantial portion of your wealth. Be mindful of these invisible taxes and take steps to minimize their impact. Let's move on to the third hidden fee, the expense ratio shell game. The expense ratio is a seemingly straightforward percentage that represents the annual cost of operating a fund. However, its insidious nature lies in how it's deducted directly from fund returns, often going unnoticed by investors. You see the final return, but the expense ratio has already taken its cut. Within these expense ratios lurk hidden costs, most notably 12b1 fees. These fees are ostensibly used for marketing and distribution, meaning you're paying for the fund to promote itself, not necessarily to improve its performance. It's like paying for advertising that doesn't actually benefit you as a customer. Even seemingly small differences in expense ratios can compound into significant wealth erosion over decades. Consider two seemingly similar funds. One has an expense ratio of 0.2%, while the other charges 1%. Over 30 years, that 0.8% difference can translate into hundreds of thousands of dollars lost, even if both funds achieve the same gross returns. Fortunately, tools like Morningstar allow you to easily compare fund expense ratios and identify these hidden fees. Before investing in any fund, conduct thorough due diligence and scrutinize its expense ratio. Don't simply rely on past performance. Look under the hood and understand what you're truly paying for. Think of high expense ratios as purchasing a brand name product versus a generic alternative. Are you truly receiving superior quality, or are you simply paying for marketing and distribution? In the world of investing, often the lower cost generic option provides the best long-term value. Now, let's uncover the fourth hidden fee, the product placement trap. This insidious fee arises when financial advisors recommend specific investment products such as annuities or loaded mutual funds that generate higher commissions for them. It's a clear conflict of interest where advice is driven by commission incentives rather than your best interests. Advisors may subtly steer clients toward these products even if they aren't the most suitable or cost-effective options, sacrificing client returns for personal gain. The allure of higher commissions can cloud judgment, leading to recommendations that benefit the advisor more than the client. Sadly, there are countless case studies of investors who were sold unsuitable products due to commission incentives, with devastating consequences for their retirement savings. These stories serve as a stark reminder of the potential dangers of conflicted advice. To protect yourself, ask your advisor direct, pointed questions about their compensation structure and any potential conflicts of interest. Don't be afraid to seek a second opinion from a fee-only advisor who doesn't receive commissions on product sales. Think of it like a chef recommending only dishes that maximize their own profit margin, regardless of your taste or dietary needs. You deserve unbiased advice, tailored to your specific circumstances, not influenced by hidden commission incentives. Demand transparency and prioritize your financial well-being over an advisor's personal gain. Let's expose the fifth and final hidden fee, the inactivity fee paradox. It sounds absurd, but some brokerage accounts and retirement plans actually charge inactivity fees for accounts with low trading volume or infrequent contributions. You're essentially being penalized for a long-term buy-and-hold investment strategy, often considered the most prudent approach. The irony is striking. You're encouraged to invest for the long term, yet you're charged a fee for not actively trading. It's a peculiar paradox that highlights the often misaligned incentives within the financial industry. Many financial institutions levy these inactivity fees, often waiving them only under specific conditions, such as maintaining a minimum account balance or executing a certain number of trades per year. The specifics vary, but the underlying principle remains the same. You're paying for the privilege of doing nothing. To avoid these fees, carefully review your account statements for any hidden charges. Consider consolidating accounts to meet minimum balance requirements and avoid inactivity fees altogether. Setting up automatic contributions, even small amounts, can also help maintain activity and prevent these fees from kicking in. Think of inactivity fees as being charged for not using a gym membership. You're paying for a service you're not actively using, and that cost still erodes your overall financial health. Stay vigilant, review your accounts regularly, and take steps to avoid these paradoxical fees. We've journeyed through the murky waters of hidden fees, exposing the silent wealth thieves that can erode your financial future. We've unmasked the AUM illusion, the invisible tax of transaction costs, the expense ratio shell game, the product placement trap, and the inactivity fee paradox. Individually, these fees may seem insignificant, but collectively, they can decimate your wealth over time. The key takeaway: knowledge is power. By asking probing questions, scrutinizing your account statements, and seeking advice from fee-only advisors, you can take control of your financial destiny and protect your hard-earned wealth. Financial literacy and a proactive approach are your most powerful weapons against these hidden costs. Warren Buffett wisely stated, "Risk comes from not knowing what you're doing." This applies directly to to understanding all fees and costs associated with your investments. Don't blindly trust your advisor. Demand transparency and understand exactly how you're being charged now. It's time to take action. Implement the strategies we've discussed, optimize your investment returns, and reclaim control of your financial future. Don't let these hidden fees continue to silently erode your wealth. The path to financial mastery requires vigilance, skepticism, and a commitment to continuous learning. By arming yourself with knowledge and taking proactive steps, you can build the sustainable wealth you deserve and achieve true financial independence. Are you ready to step into your power and become the master of your financial destiny?